All right, Sony's latest Q2 numbers are out, and honestly, it's a really fascinating story. We're going to break it all down for you. We'll look at the record highs, but also a pretty big risk that's starting to show up in their most important division. Let's get right into it.
Okay, so we're not going to waste any time here. The full report is a lot. But really, the whole story of Sony's quarter boils down to three key things. And if you're an investor, you absolutely need to know these. So what are they? Well, first, the top-line numbers look fantastic. I mean, so good that they've actually raised their forecast for the whole year. But, and this is a big but, there's a major problem brewing in their gaming division that's exposing some real risk. And third, while gaming is stumbling, two other parts of the business, music and sensors, are just crushing it, basically carrying the whole team.
Okay, let's start with that big picture. Because, on the surface, things look really, really impressive. This is definitely the story Sony wants everyone to focus on first.
So check this out. Sales hit 3.11 trillion yen. That's a solid 5% jump from last year. You love to see that kind of healthy top-line growth.
And here's what's even better. Operating income, that shot up 10% to 429 billion yen. Now, that's what we're talking about. It means their profitability is actually growing faster than their sales, which is a huge sign of strength for any investor.
And you don't have to take my word for it. Sony's own CFO, Lin Tao, came out and said it flat out. Both sales and operating income were record highs for the second quarter. So yeah, that's the big, shiny headline number that gets things started. But like I said, you have to look beneath those record numbers. Because there is a pretty big problem brewing in their most important segment, gaming and network services. And this, right here, is where the story gets a whole lot more complicated.
Get this, the operating income for that division actually fell by 13% from last year. Think about that for a second. In a quarter where the whole company is hitting record profits, their biggest, most important division is going backwards. That is a massive red flag.
So the big question is, why? What happened? Well, this wasn't just some small miss. The main reason was a gigantic 49.8 billion yen write-down, and it's all tied to their big acquisition of Bungie. That is a huge impairment loss.
And they're not even trying to hide it. The CFO is pretty blunt in saying that Bungie's big game, Destiny 2, just isn't hitting the sales and engagement numbers they expected when they bought the company. So that financial risk everyone talked about with that deal, well, it's not a what-if anymore. It's happening right now.
Now, it's not all doom and gloom in the gaming division. I mean, they've had some huge wins, too. You've got Helldivers 2 doing incredibly well on multiple platforms, and Ghost of Yoti became a massive hit, selling 3.3 million units. So their studio strategy can definitely still crank out winners. The real question is, can these hits make up for the big miss on their huge bet on Bungie?
So, while the gaming division is dealing with all these headwinds, two other parts of Sony's business had, just absolute blowout quarters. They were the ones who basically carried the entire company's profit growth on their backs.
First up, let's talk about the music segment. Its operating income just surged by an incredible 28% year over year. That is a huge, huge beat for that division.
And you want to know what the rocket fuel was? It was the absolutely phenomenal success of the anime film Demon Slayer. It technically falls under their visual media business, but that's all part of the music segment. And the scale of this one movie, it's just mind-boggling. The CFO laid out the numbers. Almost 78 million people have seen it worldwide. The box office revenue is pushing 95 billion yen. It just goes to show you the incredible power Sony has to take one single piece of content and turn it into a global money-making machine.
Okay, so that was engine number one. Engine number two, their Imaging and Sensing Solutions division, was maybe even more impressive. Their operating income just rocketed up by 50%. Yeah, 50. Now, this is the part of Sony that makes those little camera sensors for pretty much every smartphone out there. And their crazy growth wasn't because they sold more of them. It was because they sold better ones. The demand for those bigger, more powerful, high-end image sensors for new flagship phones is exploding, and Sony basically owns that market. They are completely dominating.
So you've got this weird situation, right? Gaming stumbles, but music and sensors more than make up for it. So, what does all this mean for the full-year outlook? And, maybe more importantly, what does it mean for shareholders?
Well, it means the company is feeling pretty confident. Confident enough to raise its guidance for the entire year, across the board. They've bumped up their operating income forecast by a full 8% to 1.43 trillion yen. That's a really clear signal that they feel good about their momentum.
And hey, they're not just keeping the good news to themselves. To reward investors for this performance, Sony also announced a pretty significant new plan to return capital right back to shareholders.
They've set up a new share buyback program for up to 100 billion yen. Now, when a company does this, it's basically management signaling that they think their own stock is a great investment. It also helps support the share price, which is always good news.
And all of this leaves us with one really critical question, doesn't it? The story of this quarter is pretty clear. That big acquisition risk in gaming, it's not just a theory anymore, it's very real. At the same time, the amazing strength we saw in music and sensors totally saved the day. So what's the takeaway here? Is Sony's diverse business a brilliant way to hedge against risk? Or is the trouble we're seeing in their biggest division a warning sign of even more challenges on the horizon?